And for those of you who live on the East Coast, which I'm guessing is probably the majority, the Panama Canal widening will be completed in 2014. And once that's done, it will now, for the first time, be cheaper for Eastern Asian exporters to send it all the way by sea and up into ports like Port Newark Elizabeth than to ship into California and take it overland by truck. Without that Panama Canal widening, it's actually cheaper for them to bring it into California and bring it by truck and rail to the East Coast. Actually cheaper. Once they can get more efficiency, more volume going through that port, that'll all change. And with that, we're also seeing a boost in warehousing demand, major distribution centers that are being built and getting closer and closer to the ports to be able to ramp up for that flow of goods, that increased flow of goods beginning in 2014. When we take a look at the manufacturing index, here's another reason why warehousing is doing so well. Look at how sharp the rise in manufacturing output has been in the United States since the recession. Since the recession, here we saw that decline from 07 to 09. Look how sharp it is. It's withered a little bit, but manufacturing went through the roof these last few years. Why? Exports to Europe, because the dollar has been so weak that our products are now competitive in foreign markets. As the exchange rate goes down, that makes our products cheaper and cheaper to foreign consumers. We're actually able to make things here and ship them over to there and sell them for less than what it costs to make them there because of the exchange rate advantages. So to put it simply, this probably is not durable. Because once the Fed stops stimulating the economy and inflation kicks in and the dollar exchange rate starts to swing back in favor of the dollar, manufacturers are going to lose that edge in foreign markets. But for now, big export increase, especially here in New Jersey. New Jersey's manufacturing exports are predominantly to Europe. This sort of weakening over the last 18 months, that's the euro crisis. Europe has gone into a recession. Consumers are spending less demand for manufacturing exports from the US. We're directly tied to that. We're completely tethered to what's going on in Europe. Plus, all of our banks in the US have billions of dollars in play in Greece, in Ireland. Talking about the too big to fail banks. And the last time they went through a shock like that, look at what the Federal Reserve had to do. Step in and spend $3.2 trillion to try to avoid a complete meltdown. That's what it cost. And this is now going to be personal opinion. I'm so happy they did that. Because if they hadn't done that, we were on the brink of destruction. That was a song, Chuck. On the eve of destruction? we were on the eve of destruction. I mean, you don't know how close we came. You don't know how close we came to standing on lines to get staples, bread and water and food. Because if that thing had melted down, the effects would have been so extensive that the kind of things that would have played out was that as the system froze up financially, trucking companies wouldn't have had the money to be able to keep the trucks rolling, to get the food to your grocery store. That's how far that overextension of the housing market, that reckless overextension of the housing market, and the complete lack of governmental oversight, complete lack of it. The SEC allowed the too big to fail banks, raise their leverage rates in 2014 from 12 to 1 to 33 to 1. They allowed it. Now, do you know what 33 to 1 leverage means? That means that you only have 3% of assets for every dollar of debt. That means if your net worth as a bank falls 3%, you're insolvent. Now, it works on the way up. 33-to-1 leverage is fabulous when you're doing well. On the way down, you know what happens? Exactly what happened. And everybody watched that. That was known at the time. Warehouse. Vacancy, look how sharp the decline is nationally. Absorption, look how strong and tall the absorption bars are. Very different than what we saw in office and retail. This is a leading sector. We'll have to see what happens on the other side of this recovery when the dollar starts to rise in value and the exchange rates start to flip. The hope is, the game plan is, by the time that happens, our consumers will be in better shape and they'll be able to pick up the slack on spending. Certainly a possibility. We'll see how that plays out. Warehouse rents are rising, both for warehouse as well as flex space. Stronger increases in warehouse than in flex. You see that the increase in rents in the third quarter have been at a slower pace in warehousing than we had in the second quarter. That is the recession in Europe, which is the result of the euro crisis. And property index at about 130, so apartments are up 60% in value from 2000. Everything else is up between 20 and 30% in value from year 2000 as a base year. A little bit better than the 127 and the 123 we saw in office and retail. Not as good as the 160 that we see in the apartment market because that's the darling of the investment world right now. And now we're ready to look ahead. Now, with all this analysis behind us, there are all of these wild cards. I think I touched on all of them. Yeah, I did. And by the way, the U.S. economy is definitely on life support today because imagine where we'd be today if interest rates weren't where they are. You know, if interest rates were allowed to flow freely, if the Federal Reserve wasn't stomping them down, and I'm not criticizing for that action because without that things would have been worse. The difference was that back in 2001 and 2002, the Fed dropped the rates. The economy was back up to full steam within less than a year. After September 11 terrorist attacks, the Fed left those interest rates there for 4 more years in a strong economy, which created this artificial fueling of what was going on there. We didn't need that leverage then, and we're paying for it today, but we're still on life support, you know, and we've got a way to go. And so at some point, that life support's going to get removed, and we're going to need to be able to pay as we go. And hopefully, the economy will recover to that point. The fiscal cliff is coming up at year end. We've got a payroll tax holiday for Social Security taxes, which will expire on December 31st. Average cost of $1,000 for the average household earning $50,000 a year, additional Social Security taxes. In addition to that, we've got the Bush tax credits, which are tax cuts, which are scheduled to expire. I love the way the politicians deal with this. You know, because one way to look at a tax cut which is set to expire is that what we've heard is if the tax cut is extended, that counts as cutting taxes, which are already cut. You know, so there's sort of this double ledger, double entry accounting that goes on in all of this. You know, it's getting counted on both sides. I get a kick out of that. Those of us that are analysts, which we all are, got to look at that stuff and say, I can tell that you've never run an organization or a company where you needed to calculate whether your operations were profitable or had to do a P&L statement. You don't get to count it on both sides, but anyway, that's government. So that's approaching. We've got these problems in Europe, which, you know, Angela Merkel was in Greece 2 weeks ago, and there were riots in the street. You know, the Greek people are saying, let it go, leave the union. We want our pensions. We want our jobs. And the German people are saying, let them go. We're tired of sending our money there. We don't take a 2 or 3 hour siesta, like this is what they're saying in Greece, like they do in Spain. They call it siesta. We call it work. So there's all that going on. They're not going to let that thing fall apart. There's too much at stake. That will get solved. I'm convinced that the federal government, after the election, no way to touch it now, I'm convinced that after the election, they figure out something here. Now, I don't know what the something's going to be. It could go a lot of different ways, but I think that some of these tax cuts are going to get extended, and the quid pro quo is going to be, in exchange for the extension, a working agreement to have a new tax code a year from now, which lowers rates and eliminates deductions for high income earners. I think that's something that most people are going to go along with. At the end, right now you can't, because everybody's looking to get an advantage. And then we have this Middle East volatility. This is the one that I worry most about. That's the one that I cannot make a call on this one. I don't know what's going to happen. I certainly hope that cooler heads prevail. But this one's a tricky one. This is a tricky one. Has anybody watched the TV series Homeland? They already came up with the answer to this question. Because in their opening series, Israel had already struck. In their opening episode this year, Israel had already struck Iran. And it didn't work. They hadn't been able to do the damage that they had intended to do. And so now everything is starting to come to a boil in the Middle East. That's the one I can't tell you how that. I think the other three are going to work out. This one here, I'm not sure. Keep our fingers crossed. Okay, I talked to you at the very onset about beneath all of the recent chaos, there have been some structural changes taking place in the United States for a long time as a result of the collapse of the Soviet Union, the reset in our economy, our losing our competitive edge, our country trying to export democracy and free trade for decades, and then the rest of the world finally saying, okay, come on in. And once we came in, and we started to sell once Procter & Gamble started to sell its products in Mexico without tariffs or trade restrictions, it wasn't long before they said, you know what, as long as we're here anyway, why don't we just make the stuff here? Because people here work for less. That's what Ross Perot was warning us about. That's what he was warning us about. Okay, so this is the slide this is the Jack Nicholson moment in A Few Good Men. You remember it? Yes. You want the truth? You can't handle the truth.
You want me on that line.
Let me tell you how it really is. Here's the slide. Very depressing. This slide is very depressing. Neither politician is going to go down this road in this election because the pushback on both sides is more than they can contain. There is no public relations strategy that will contain this information, that will control this information. That red line, we've been looking at that red line all morning. That's the job loss and recovery line here in the United States. And what we're looking at is the 8.7 million jobs coming down that we lost, and the recovery of 4.1 million of those coming up. And you'll notice that the red line today is not yet halfway back up to where it was at the beginning. That's familiar to us at this point. The blue line is US GDP, what our economy is accomplishing, total economic activity, what we call GDP. I want you to notice that the blue line on the right is higher than it was before the recession began on the left. Truth, the economy is fully recovered. It just doesn't need those extra 4.5 million workers anymore. They're not necessary. They're not getting their jobs back. That tells you therein lies the new normal. Therein lies the reasons why some people believe that we need to give more assistance and more entitlements to the American people who are out of work or don't make enough money to pay their bills, because without the assistance, the truth is, there's no ladder for them to climb back into the game. But what we understand is that in order to accomplish that type of social programming, we need to tax businesses more. We need to, you hear the conversations about raising the minimum wage. We need to raise the minimum wage. And then there is the other side that says, if that's your solution, there will be an even larger sucking sound that you'll hear because that's how we got here in the first place. And that's why I don't think we solve this problem. Because we have two polar opposites. And both are right. Within the context of the way they're looking at it, both arguments have merit.